Hi guys, today we have a special guest, Mikolaj Barczentewicz, my friend from Oxford, who is an awesome lawyer, and we're going to talk about crypto regulations and generally speaking, market manipulation. What is market manipulation, how you should address those issues, and what's being changed right now in European law or international law. And we're going to also talk about MEV, maximum extractable value, because Mikolaj is an expert from the law side perspective. So let's get started. Hi, Mikolaj.
Hi.
So let's get started with market manipulation itself. Like, what's the general definition of market manipulation? How it can affect crypto in general? We have a couple of cases, guys. You might know the Avi case with Mango Markets, the exploiter. So we're going to talk about that a little bit.
So market manipulation is defined a bit differently in different jurisdictions. So the approach will differ slightly in the US from the European approach, but what I think is a somewhat common feature of all the jurisdictions is that it's a bit of a mess, the regulation of market manipulation, because it's and sometimes you will almost have this impression that it's a lot of I know it when I see it. So if you and it will depend a lot on the judge you will get. There are some types of market manipulation which are, for example, in European law are even listed in the regulations, and one type which is probably quite common in DeFi and in crypto markets in general is wash trading. So I'm not sure everyone realizes that, but wash trading or wash sales, so which is where you trade with yourself or someone who's cooperating with you, and your goal is to, for example, pump the price of an asset or create an artificial impression that there is a lot of volume on some protocol or some market. Well, that is wash trading, and that is prohibited both in the US and in Europe. So that's one example.
That's very interesting, because I think there's a lot of market manipulation in NFTs right now with like farming Blur token or like farming all the new NFT marketplaces. So how legal is that?
Well, I
Right.
mean, so I'm not
depends
sure.
on
So I'm not sure what exactly is happening on Blur. So if it's, for example, if it's wash trading, that would be relatively easy to classify as market manipulation. But there could be sometimes another thing that is quite common in crypto is pump and dump schemes. So that would very likely be almost always classified as market manipulation. So I'm not sure what else is happening on Blur.
Yeah, I think Blur is maybe an easier case because they have just an incentive for bidding and listing as much as possible. So it's less about like they don't really promote selling to yourself.
Right.
You could still sell to yourself and wash trade and get some points for like the next airdrop or whatever, but it won't really, it's not recommended in any way, and you would lose a lot of money doing that. So, but definitely some wash trading is happening on different NFT marketplaces, and you can even see that on OpenSea, because OpenSea in a trending spot promotes NFTs that have the biggest volume. So the easiest option, of course, for the new collections is to wash trade so that they are on top, and this is actually happening pretty often. And I think OpenSea right now does not have a solution for that.
So this is quite tricky. Of course, it's not legal advice for anyone, but personally, I would be very careful not to do that.
From the perspective of the collection, I guess, because
yes,
OpenSea is not liable in any way here.
Well, it is. So this may depend, and the rules for to what extent exchanges or platforms for trading may be liable. That may also change, especially in Europe when MiCa is enacted. So that we can talk about that later. But yes, I think the primary person at risk is whoever is doing it.
Okay, so what about jurisdiction then? Because that's like a tricky question from my side. Like, which jurisdiction should you consider doing this? Like, if you have a team in Asia or decentralized team with people from from Asia to Africa to America, what's the jurisdiction? Like, which definition of market manipulation we should take, and what should happen here?
So there may be a somewhat practical answer, which is even if, for example, American law or European law claims to theoretically apply to wherever a user is coming from, if there is enough of a connection with a market or an asset that and this asset or a market has a connection to America or to Europe, that would be enough. But that may not matter if the risk that you will be prosecuted by, for example, American law enforcement or by European law enforcement will be very low because you are based in Africa or in China. So there is the issue of what the law says, and it is very likely with those market manipulation rules that those the jurisdictional scope will be defined very broadly. But then there is the separate question of what's the likelihood that someone that
will apply this
will apply it specifically to you if you as a person don't have a nexus, don't have a connection to that jurisdiction.
Right. So even if I have like the team totally outside of the US and Europe, I still might be liable in the US when, for example, majority of users are in the US, or there are some people who are affected by the actions of the team from outside.
Well, there were cases in traditional finance where there was a famous case. I think it was connected with the famous flash crash. I forget the year, 2010 maybe. But one person who was prosecuted for that, even though it was a crash on the American market, the trader was based in England.
I remember that case.
And he was prosecuted for that by the Americans. So similarly with LIBOR manipulation. So for example, Tom Hayes, he was and others. There were prosecutions both in America and in the UK. And even though, at least for a large part of the time when this was allegedly happening, I think Tom Hayes was based in Tokyo.
Oh, very interesting. Yeah, because I think like a lot of folks actually think that the US regulation or European regulation does not really affect crypto because they can run away, but to some extent they probably can't because, well, maybe they can if they completely separate themselves from the European market and from the US market, but other than that, you're basically still liable. I want to talk about the case of Avi and Mango markets. Basically, so for those of who don't remember, that was basically the exploit of the Mango markets, where actually, thanks to the smart moves on the Oracle, basically the exploiter managed to get a large amount of money from the exchange, from the DeFi protocol.
Yes.
And well, judging by Cody's law, everything he did was legal because Code was allowed him to do that, even though it was against the will of the founders of the protocol itself. Right now, I think Avi is, because he actually, there was a guy called Avi. He came out on Twitter saying that was him plus his team. He managed to do that, and he said that basically everything I did was legal. I was doing everything that smart contracts allowed me to do. So this is it. But actually he got arrested, and I'm super curious about what's happening, why he got arrested, what he did wrong, and how does that play into market manipulation.
So Avi's case is in some ways relatively simple because there were many stages to his strategy, and for example, one of those stages was where he engaged in something that looks very much like a wash trade, which means that he traded with himself to create a perp. To create that perp position, he took both sides with two different accounts, and one of those accounts he then abandoned. So that was one problem. The other problem was that he did clearly try to pump the price. So that you could say artificially on several markets. I think one of them was FTX, so both on centralized and some decentralized markets. So and this legally would probably be classified as sending false signals to the markets or as price manipulation. So you have price manipulation, you have wash trading, and then you have this situation where he takes a loan from Mango markets, which he clearly does not intend to repay. which also seems like a fraudulent activity, right? So if you look at it from a legal perspective, and from looking at it, look at those perps as derivatives, as at the so Mango Markets lending as loans, those things really look fraudulent. So I'm not optimistic for him about his chances of him not going to prison for a relatively long time. But the question that you asked, whether about code as law, is I think still worth asking. And I know that there are some lawyers in the crypto space who do stress that, well, maybe we should be looking at it differently. Maybe we shouldn't be comparing lending on a DEX, like in this situation, to normal lending, that and perhaps even this intent not to repay. So this is known as an under collateralized loan attack. So maybe that also should be seen as just contributing to the overall security of DeFi, because you, by doing this, in a sense, I mean, it's a bit of a stretch, but you could say that it's almost like a public service, that you're keeping the devs honest, and in that way, by doing this, you are making the space stronger. I mean, it's, for a prosecutor, this will probably, and for a judge, will probably sound too much as a stretch, but for the community, I think it is an interesting debate to have.
Yeah, definitely, because, well, that was, I guess, the case with the DAO hack, right, from 2016, was it, on the Ethereum? But
the first DAO,
DDAO that was hacked. I don't know what's the legal status of that. Like, could you prosecute that? Probably, because that was a different case, because there was, like, as far as I remember, there was no market manipulation, like no one was trading. Maybe
I think it was mostly sort of an exploit.
Exactly. Exactly.
So it was more like a hack than.
So I guess this is
market manipulation.
Exactly. So this is like closer to Cody's law case, and this probably you could argue that was legal to a certain extent,
well, that's what the DAO hacker argued. So we do have. You can read the great book by Laura Shin about the history of Ethereum and about the DAO hack especially, and she also discusses those public forum messages or emails from the DAO hacker, where he makes this argument. Well, code is law. What I did is fine. But the DAO hacker never came out. So unlike Avi Eisenberg, the DAO hacker never identified himself. So Laura Shin published recently her analysis of who she thinks is the DAO hacker, but I'm not aware of any enforcement action against that person.
Yeah. So what about, going back to Avi? What about him? Like, what was the jurisdiction that actually arrested him, and what was the charges that he was arrested on? So
Avi is American, and Israeli, as far as I know, and he was based in Puerto Rico, which is America, at least allegedly, when he did when he performed that strategy. So that's a pretty simple jurisdictional case. He's American. Well, he did. He was in America when he was doing what he was doing. So that opened.
Mango Markets were American, or they were
Mango Markets. So I'm not sure whether how.
Who was the one to enforce actually and ask the.
So the enforcement against Avi was first from the FBI. So more broadly from the U.S. Department of Justice, and that's how he was arrested. So anyone can read a very interesting affidavit by the FBI special agent, which is actually quite good in terms of understanding of the mechanics of DeFi and what happened. So that was the first thing. It was FBI.
But who actually got who asked FBI to step in? Like, who was
it's hard to tell. I mean, it was very public, and it was also covered.
Or was FBI in the Mango Markets and they were unhappy about the results?
Well, I don't know, but I think it was pretty broadly covered in the press, maybe even in non-crypto press. So that's an unlucky situation for you if you become famous that way. And so in a sense, even the press coverage, I think, made it quite clear that it will be an easy prosecution, and easy prosecutions are very tempting for the law enforcement. So it started with the FBI and the Department of Justice, and then the two U.S. Financial regulatory agencies stepped in. So first it was the CFTC, and then the SEC. A bit later, and they brought their own complaints against Avi. So the CFTC regulates the commodities market, and I think the general understanding is that many, if not most, crypto assets are commodities. So on that theory, they were generally, and they have an authority to police market manipulation in commodities. So that was their basis, and the SEC had to allege that something in this space was within their jurisdiction. They deal with securities, so that's always a bit more tricky. But yes, so we have FBI, the Department of Justice, the CFTC, and the SEC. So the holy trinity of U.S. law enforcement. They all.
So quite unlucky for him then.
It's very yes.
Well, but he was quite open about what he did.
He was very open, and it's really. It's an interesting situation because he claimed that what he did was legal.
Yep.
And he even cited some court cases. One court case which is quite well known for people who work on U.S. financial regulation, where a judge seemed to suggest that, well, it's not illegal if you're just smarter than another market participant, right? Being smarter or using just a market opportunity that other people don't know about, or knowing the market infrastructure better, is not in itself manipulative. The problem is that several things which he did in his strategy went beyond that, merely being smarter. Like the loan that he didn't intend to repay, the wash trading. I mean, it's just very interesting that he seemed to be quite convinced that this law argument was going to protect him, but yes.
Well, let's see. I think it's an ongoing case, right?
It is an ongoing case. It is an ongoing case, but just if I were to bet, I wouldn't bet so that he will get away with this.
Okay, with nothing. Okay, so going forward to MEV, maximum extractable value, I wanted to have your definition of MEV first, and then maybe we talk about how MEV plays into market manipulation as well. What might be the cases for the for MEVers or people doing that?
So maximal extractable value, I used to accept this definition that MEV is whatever the value or the profits that a validator can extract or just realize above their regular validator rewards, which you get, like a minor reward on.
From rearranging blocks in a space, or like getting someone first rather than the other person.
So as a validator on Ethereum, you have a certain set of duties, and if you perform those duties, you get your validator rewards. So that's the baseline. That's what everyone gets, and then is the issue that with your special position, especially if you're a proposer, so you're the one who controls a slot or has this privilege to put a block in one slot, then you can make some more money on it. So some people say that MEV is only refers to this additional profit, but I now tend to think that we probably should think of MEV as just all the profits that a validator can extract from their position of privileged control of block space.
So would staking go under that as well?
Yes. So it's in a sense
reward from the everything.
Everything is MEV, and I think it also helps to. It's a good approach because it shows that it's MEV is not one thing, and it's not necessarily bad, right?
Right. Yeah. So it's there's no simple answer. What's legal, what's illegal here? You have to go into details.
Yes.
And what are the details here? Because you can argue that some parts of MEV are illegal. For example, those maybe let's talk about that. Those being more aggressive on other users. So, for example, sandwiching or allowing sandwiching for others. Because I guess thanks to Flashbots, you don't even have to do the sandwich yourself, but you can allow others to do the sandwiching by putting them first.
Yes.
Right. So they're like
as a validator.
as a validator from the validator
Yes.
perspective.
So as a validator on Ethereum today, it's true that you can profit from MEV extraction without directly engaging in MEV extraction, right? We have a competitive market for searchers and block builders, and they tend to engage in that, and many, if not the vast majority of validators, they simply accept a block already including sort of various MEV extraction strategies or attempts, and you just take the fee for it. So yes, that is an interesting question, and a question I'm working on, whether that puts validators in a legally safer position. But leaving aside the validators, just thinking about searchers or block builders, so those market participants who do directly identify MEV extraction opportunities, there definitely are questions to be asked, and I think regulators will be asking those questions about strategies like sandwiching. I have a very long paper mostly about sandwiching, where me and my co-authors, we actually argue that it's not, at least under US law, it's not so simple. It could be that in some or many circumstances, sandwiches would not be seen as illegal, but we identified this one situation where, for example,
can you tell quickly what's sandwiching, and then
yes. So a sandwich involves when you have a DEX trade. So someone's trying to swap, for example, ETH for DAI or on Uniswap V2. That may and they are setting a slippage condition. So they are setting their price tolerance that they are happy for their trade to be executed within sort of plus minus 5% of some sort of target price. So that may create an opportunity that if someone goes ahead of their trade with a front run and just behind their trade with a back run, that they will be able to sort of push this trade to go to their maximum slippage, and this way this can create a value that can be extracted by whoever is running the sandwich. So yes, there is this adverse effect of that kind of a sandwich on the DEX trade.
Okay. So about MEV, like what about the paper? You wanted to say about the cases that you identified that might be less legal than the others, or like might be liable?
Sure. So I think the fascinating case, which not many think about, but it is becoming more common or more popular as a discussion topic, at least on crypto Twitter, which is what happens to transactions when they are still private. So because every transaction you on Ethereum starts as a private transaction. First, you know about it, so it's private to you. Then you submit it with MetaMask or whatever your wallet app is, and then someone receives it. And that first node, the RPC that receives the transaction, for that moment, they also are, other than you, they are the only ones who know about it. So it sounds like this inside information, private material, non-public information.
And then it goes to the mempool, and then
the question is, does it? So if you're a node operator, if you're an RPC operator, it may be tempting to you, especially if you're a popular RPC operator, it may be tempting to you for you to treat those transactions that come to you as, in a sense, private order flow. So you first you may give yourself this privileged position of you are in a privileged position to extract MEV from those transactions before you forward them to anyone else. You may not decide not to extract MEV, submit them in a bundle like for a sandwich without broadcasting this transaction to the mempool, the public mempool at all. That's one strategy. But another strategy, a bit more subtle, is you just give yourself a head start. So for example, you rebroadcast, but only after 300 milliseconds or 500 milliseconds or even a second. Even several hundred milliseconds can be enough for you to have enough of a probability of winning the MEV extraction opportunity that it doesn't matter. So in this way, you're sort of hiding your tracks, because it's then very difficult to see that you're actually doing this, and at the same time you're getting a very high probability that you will be the one winning those MEV extraction opportunities.
Very interesting. Yeah, I didn't know about that. So, but actually, that reminds me of dark pools in like traditional finance.
Yes.
Like, what's that?
Yeah.
Because dark pools are legal, right? And then participating in dark pools is perfectly, well, maybe not perfectly. Maybe there are some nuances there.
Dark pools are legal, but the thing about dark pools is that they are usually run. I mean, they must be run by regulated broker dealers. Those broker dealers have this thing that is called the duty of best execution. So if and of course there is a bit of nuance, some MEV to be extracted on the edges of what's best execution means, but in principle they cannot adversely affect their clients. At least within the sort of gray zone of the definition of best execution, right? So they have a legal duty to give the best execution to their client. Whereas here, it's not clear whether an RPC operator has any legal duties towards users. Perhaps they do. Perhaps this will change, for example, in the EU with MiCa, that something like a duty of best execution will be imposed on RPC operators. So I think these are very fascinating questions. But you can think, at least there is an intuitive argument that as a user, you really don't have a choice but to trust some RPC operator, right? So, and because even though the blockchain is public, the peer-to-peer network, the Ethereum network, is not really public, and there are many things that can be hidden there. So, as a user, you're in a position of an asymmetry of power and information vis-a-vis all those operators in the peer-to-peer network. So that usually is seen as a good argument for the law to step in and somehow to address this asymmetry of power.
Okay. Yeah. So what about the searchers who, like, in the beginning, like how legal is sandwiching in general, basically, or does that depend on a case? There's this case is like, someone buying a coin, there's a slippage, and there's just somebody enters, buy before him, sells after him, and profits of the difference.
So in the long legal paper, our general conclusion is that at least under US law, there is a very good argument to be made that if you're sandwiching transactions which are public, this would not be market manipulation. I mean, there is a risk. There is a risk that, for example, the SEC, the CFTC will try to go after sandwiching, but we cannot exclude that, and we cannot say what the court will say in this situation. But at least we think that there is a decent argument. But that's with public transactions. But if you have private transactions, it's quite tricky. So I think an interesting nuance here is that it's not necessarily the case that you could never have sandwiching of private transactions which is legally okay. Perhaps I can imagine a setup where you have appropriate disclosure, so users are told that this may happen. And for example, the users are told that a bit like with Robinhood and payment for order flow in traditional finance, that this is how we are financing our business. So you're getting a free wallet, you're getting free wallet software. Perhaps even you're getting some rebates. MEV rebates, some kickbacks on the MEV created by your transactions, but that is financed by us doing at least maybe arbitrages, backrunning arbitrages on your transactions, or maybe even sandwiching. I'm not saying that could probably work, but the difference between what is happening now and that state of affairs is disclosure and all those things which are not currently normal standard.
Very interesting. Like there are many interesting issues. You've mentioned also MiCa. I wanted to at the very end touch on that. So what's MiCa, and let's talk about European regulation as well on crypto.
MiCa is the Markets in Crypto Assets Regulation, which is a new
framework,
not quite comprehensive statute that the European Union is expected to pass to enact this year, and then we will still have an implementation period of more than a year. So there is still time to prepare for it. But what MiCa will affect, usually the general sort of narrative about this is that it will not touch DeFi. and because it's meant to deal with centralized crypto asset services, with centralized exchanges, with issuance of various tokens, utility tokens, e-money tokens, and so on. But I think that may be a bit too quick. There is a risk. For example, the anti-market manipulation rules of MiCa, they don't have that limitation that they only apply to centralized services. They apply whenever a crypto asset that is also traded, for example, on a centralized exchange, is also traded anywhere. If any behavior that may be you shilling it on Twitter or things like that, this will all come with rules from MiCa that will impose certain restrictions and potentially legal liability.
So there might be some implications for DeFi in general and like how protocols operate.
Yes.
Is there anything people can prepare for, or like just wait and see what happens?
Of course you can. So one big question that MiCa will it's not a new legal question, but it is a question that MiCa will also rely on, is the question of centralization. Because what MiCa says is that it doesn't apply to services which are provided in a fully decentralized way without any intermediators. And this raises a very interesting question, and there is still time for protocols and services to adjust to it, right? So the question is, can you, if you're not already, can you move to a situation where we could say that you really are fully decentralized? Right?
So what does fully decentralized mean? Really?
No one knows.
No one
knows what it means. I'm trying to answer that in my own research, but yes, no one knows that yet. But what may be easier to answer is what is not full decentralization. So
that's easier probably, because
and this may actually even touch on layer 1 blockchains or on layer 2s. So you may think, well, just because something is a layer 1, it doesn't mean that it's fully decentralized.
Right.
Even if it has many validators, it doesn't mean that it's fully decentralized, because, for example, this is something we don't yet know, but it could be that full decentralization will be interpreted as requiring permissionlessness. So if you have a layer 1 blockchain which has a permissioned validator set, that may be not full decentralization.
There's proof of authority blockchains, right? Which are basically, you have a small council of validators who are predetermined. You have to apply to be there. So
that's one possibility. Then you may have layer 2s, you may have bridges, you may have protocols and dApps, which for in one way they may say, oh, we are governed by a DAO, but actually, if you look under the hood, what happens is that this is an upgradable proxy. There's a proxy contract, and the upgradability function is managed by a multi-sig of 6, or like 6 out of 9 or whatever, right? And is a multi-sig of 6 and an upgradable sort of contract, proxy contract, is that full decentralization? Or are those people, those people who are part of the multi-sig, are they actually the collective crypto asset service provider who will have to, if they are based in the EU, they will have to register, they will have all sorts of regulatory duties. So yes, so those are the questions for DeFi that still need to be answered.
Very interesting. Thank you for the chat. So for the final thing, where people can find you? Where Twitter, I guess,
so
mostly Twitter.
I think Twitter is best. So my crypto Twitter account is 0x Mikolaj, Mikolaj.
The link will be down below in the description.
So follow me there.
Okay. Thank you for the chat again.
Thank you.
And thank you for watching.